How much do you need to invest in private equity? Most people think private equity is only for the ultra wealthy. That is not true anymore. In this video, I'll break down with you how much you need to invest in private equity and how you can get started even with a smaller budget. Can you invest in private equity with $1,000? What about $100,000? I'll walk you through the different ways to invest, whether you're just getting started or you're ready to go all in on private equity. If you ever wanted to invest in high return private equity deals but didn't think you had enough money, then this video is for you. Stick around and I'll show you the options that you have at every investment level. By the end of this video, you'll know exactly how much money you need to invest in private equity, what options are for you, and how to decide the approach that fits your investment needs most. First, there's this myth that private equity is only available to high wealth individuals. That is just not true at this day and age. Many people assume you need millions of dollars to invest in private equity. And yes, that can be the case, but there's a lot more options today that are available for the retail investor. Retail investors now have the options to invest in private equity through crowdfunding, through real estate investment trusts, and through private real estate funds. So I'm going to break down how much money do you need to invest in these types of real estate private equity vehicles. Number one, crowdfunding. Crowdfunding starts with $500 to $10,000 or more. These platforms are Fundrise, Realty Mogul, CrowdStreet, and there's many more you can find around the internet. Next, private REITs or interval funds. This investment level is $10,000 to $50,000. These include REITs like Blackstone Private REIT, Starwood Private REIT. Next, private syndications and real estate funds. This investment level is $50,000 to $250,000 plus. Patriot Fund 5 is a private real estate fund. That is my real estate fund. And there are many other private syndication and funds available. Institutional grade private equity funds. This typically is $250,000 to up to $5 million or more. These are major private equity firms like KKR and Blackstone. They're hedge funds, also different hedge funds, and only available to ultra high net worth individuals. Typically, you need to work with an investment banker to get into these types of deals like UBS or JP Morgan Chase. All right, let's break down the crowdfunding platforms. These are the most accessible option to the beginning investor. $500 to $10,000 is typically the entry investment. They're best for new investors that want to get a feel of deals, get a feel of the sponsor or the general partner. How do they communicate? How do the investments perform? You can get exposure to these investments by picking out on the crowdfunding platform what deal or what fund works best for your strategy. The pros are their very low minimum investments, easy access to pick through different deals that you want to invest in, and they're completely passive. You do not have to manage any of these investments. Cons, there are higher fees typically involved with these types of investments. You have little to no control. You are a passive investor, and there's lack of transparency. At times, the reporting through these platforms is not that clear. These platforms include Fundrise, CrowdStreet, Realty Mogul. Please do your diligence on these platforms and only look for deals that have a reputable sponsor or general partner managing them. Private REITs or interval funds. These typically are $10,000 to $50,000 plus in an initial investment. These are best for investors looking for private market exposure in private equity funds, but still want liquidity to their capital, meaning that they can get their investment back sooner than the typical private equity fund that is a minimum of 3, but mostly 5+ years of your capital being tied up in the deal. In these funds, you get a diversified portfolio, more liquidity than a traditional equity investment, and they can yield steady returns. The cons are customarily their returns are lower than direct private equity investments, and there can be redemption restrictions, meaning if a large portion of the limited partners or investors want their capital back at once, these funds can restrict paying back that capital. Examples are Blackstone Private REIT or Starwood Private REIT. A quick story on Blackstone's private REIT, it's called the B-REIT, is they had a large amount of redemption requests where investors wanted their capital back during COVID or right post-COVID, and Blackstone had to cut off that redemption request. They're only obligated to pay back 5% of the investment capital in any given quarter, so they stopped paying back investors their capital, and they did require the investors to stay into the deal until they got more liquidity, and then they started honoring more of the redemption requests. That is a limitation with some of these private REITs. Private syndications and funds. These investments start at $50,000 to $250,000 plus. These investments are great for investors that are looking for higher than average returns, tax benefits, and access to off-market deals. They allow direct ownership in the asset, higher cash flow distributions, and tax-efficient investing by getting depreciation with your investment and allowing investors to 1031 into some of these private funds or syndications. The cons are these types of funds customarily require an investor to be accredited, meaning they have $1 million of net worth, excluding their primary residence equity, or they've had a salary of $200,000 a year over the last 2 years. Another con is these funds are illiquid. The lockup period is at least 5 years, sometimes up to 10, where the money cannot be withdrawn from the fund. When vetting an investment partnership or fund, you always want to look at track record. Does the sponsor have a good track record in that specific asset class that you're investing into? Next is transparency. Do they communicate often and share the wins and the losses with their investors, providing updated profit and loss reports, balance sheets, and property updates? Third is an alignment of interest. Does the investment sponsor or general partner invest alongside the investors? Here at Patriot, I invest at least $1 million into each of my 5 funds, ensuring that investors know we have an alignment of interests in my capital and in theirs. And lastly is large-scale private equity funds. The bare minimum is $250,000, and many times it's over $5 million for these type of exclusive investments. These are best for large investors wanting institutional grade investments in venture capital, real estate, and private equity buyouts of businesses. The pros are you get the highest level access to deals, professional management, and strong returns. The cons are there are high lockup periods, meaning at least 5 to 10 years is the life of the investment fund. There are high fees involved with these investment fund managers or investment bankers, and these always require investor accreditation. Examples of these funds are Blackstone, KKR, and the Carlyle Group. Many times these investors are not marketed online. You have to go through your investment banker at JP Chase or one of the larger institutional wealth managers. Now that you know how much money it's going to take to invest in private equity, we're going to dive into the next video of how to analyze private equity deals. Just because you have the cash to invest in them, you want to make sure you invest in the right ones. I'm going to break down what are the right deals and wrong deals to invest with in private equity. Click the link below so you can start investing like a private equity pro.